lot of investors see high yield and they automatically assume it's better. But when it comes to covered call ETFs versus dividend ETFs, that could be a very expensive misunderstanding. Because even though they both generate income, they do it in very different ways. And if you don't understand that difference, you maybe end up owning the wrong investment for your goals. So today, I want to break that down in a very simple way. Covered call ETFs versus dividend ETFs. So these are two popular income strategies, but they're not the same thing. A lot of people focus on the yield first, and frankly, I was one of them. But the bigger question is where that income comes from. What are the trade-offs that comes with it? And honestly, which strategy fits your portfolio better? So let's walk through this in an organized way here. So what covered call ETFs do? Covered call ETFs usually hold a basket of stocks, or they can use some type of related strategy tied to an index or a group of stocks. So what makes them different is that they sell call options to generate income. The option premium is a big reason why these funds can actually pay these high yields. But there is a trade-off. When markets move stronger, higher, so when markets move fast and they move up, it can limit the amount of money that the fund can generate because it also caps the gains in the exchange for current income. In simple terms, covered call ETFs are designed to give you more cash flow now, but at times can lead to an expensive future upside decline. So what do dividend ETFs do? Dividend ETFs are different because they usually hold companies that regularly pay dividends. So these the income here comes from the actual dividend payments made by companies inside the fund, not from selling options. So these funds, they often have lower yields than covered call ETFs, but they also have more room for longer term capital appreciation depending on the companies that they hold. So dividend ETFs are often seen as more traditional income approach. This is the Warren Buffett kind of approach strategy. Some of the stocks like Coca-Cola and American Express, those are some of the companies that they look for. So you get some income today, but you also get to participate in a full growth income strategy later. So income, this is where a lot of investors focus because covered call ETFs often produce more income right now. The higher yield can look very attractive, especially for investors who want immediate cash flow. So people that are retired or people that need that cash to live on. Dividend ETFs usually produce less income up front, but that income is coming from a company's payout, which is a different type of strategy and a different source of income. So the important thing here to remember is that higher yield doesn't always automatically mean better total return. And total return is the thing that we're really focusing on. And it definitely doesn't mean that it's lower risk. Investors need to understand just how much income they're getting, but how that income is actually being created is something completely different. So with your growth potential, when it comes to growth potential, this is where dividend ETFs often have the advantage. So covered call ETFs can lag in strong bull markets because selling covered calls can cap that potential upside. Dividend ETFs, on the other hand, often more room for price appreciation because they're not constantly giving away the upside through options contracts. That does not mean dividend ETFs always outperform. And it doesn't always mean that covered calls are bad. It just means you have to understand the trade-off. More income means less growth later. So, what are the trade offs? This is really where the heart of this comparison lies. So, covered call ETFs can provide more cash flow, which can be very appealing to investors who want income right now. But dividend ETFs may offer more balance between income and long-term growth, especially for income investors who want compounding over time. But neither strategy is perfect. They both have their ups and downs, their pros and cons. Covered call ETFs can lose value in down markets, and dividend ETFs are not immune to market risk either. So this is about one being automatic, not about one thing being better than the other automatically. So a dividend ETF is not better than a covered call ETF, and a covered call ETF is not necessarily better than a dividend ETF. It's all about understanding what you're trying to accomplish in your portfolio and why you're in them. So which one is better fits you? So if your main goal right now in a income strategy is income, if your number one goal is income right now, covered call ETFs may be a more sensible style for your strategy. If your goal is more long-term compounding with income as part of the picture, dividend ETFs may be a better fit. And for some investors, the answer might actually be both. There's nothing wrong with combining strategies that helps your goals. So if your time horizon and your risk tolerance fit one asset or another, this is how you would make this judgment for your portfolio. So the key is making sure you own something because you understand it, not because the yields look attractive. A lot of income investors are looking for that income. A lot of growth investors are looking for a lot of that growth. And a combination of the two could be a perfect strategy for you when you're looking to retire. So my final takeaway, it's pretty simple. Covered calls can boost income. Dividend ETFs can offer steadier long-term growth potential. One is not automatically better than the other, and honestly, both have a place, depending on what kind of investor you are and what you're trying to build. So the best strategy is the one that actually fits your plan. If you found this helpful, stick around. I'll be doing more content focused on practice income investing, simple explanations, and real-world strategies. And as always, I sincerely appreciate you listening and watching. Like, share, do whatever you need to do to help out the channel. We really appreciate it. And thank you very much. We'll see you next time.